So here I'm going to go through with you some of the key concepts which we'll look at in more depth around the learning outcomes that we need to look at for this course. Okay. Um, so it's quite a broad brush really in terms of looking at the organisation, in terms of how it's operating financially and what its obligations are, as well as what type of money that it could actually secure. So when I deliver this material, I'm going to think about the type of organisation that you might be considering. So, something to have a look at when you're accessing their financial report is to consider the regulation that's in place for the organisation you're looking at. And you'll be able to, when you look at their company website, and you on the investment page, they will have annual reports, because if they're a public company where you can buy shares, which yours are going to be by the very nature of them being on the FTSE, they have to publish public information, and they've got to publish it, at least annual reports, but with shareholders they'll tend to do it quarterly as well. So what you want to check for, the first thing, is which type of accounting standards that they're being governed by. So this will be in some blurb around governance. So have a check there in terms of the financial statements, the standards which they're adhering to in their financial statements, and see what you can find about those. When you can check which ones they are adhering to, do a bit more research as to what they actually mean. The international financial reporting standards will tend to be the ones which they're complying with, but just have a look in a little more detail. Yeah, just double check and see which one your particular organisation is looking at, and then you can look at this slide in more detail, or you can look at other material to say, well, actually, what does compliance or adherence to that actually mean? The reason why we need to ensure that we're following the same rules for the financial reporting is to make sure that every year we're not costing things in a different way. We've got a benchmark and we're following the same set procedure, which is why they've looked at reporting standards internationally. So they're trying to get a consistent approach in which financial performance is measured, because otherwise organisations could manipulate their figures to show that they've done certain things, so they've performed in a certain way, whereas actually if we're all using the same basis for these calculations, we can just double check that everyone's doing it in a consistent fashion, so we can compare like against like. So that's why it's really important in terms of the financial standards, like the reporting standard, that there's consistency. So when you're looking at this, as I say, ensure it's really relevant to your organisation. Don't just go about the background. We need to, you haven't got many words, 2,000 isn't a huge amount, so we need to apply it to your organisation. And what does that mean? What does that mean in terms of transparency, reporting, governance, by following these standards? So another implication or another consideration is around what type of organisation you're looking at in terms of their financial reporting. And actually, we can eliminate some of these, because we know through the very nature of asking you to look at organisation in the FTSE that it's got to be a public limited company. So it's got to be one that's actually listed, that we can buy shares in. So we can eliminate sole traders and partnerships, because it won't be one of those, because they don't even have to register their financial accounts with Companies House. We know it's got to be a limited company, and more than that, not just a private one such as the training company that I run, which again is registered with the government. I pay my taxes, I submit my finances, but it's a public one, which gives it a totally different level of governance, because of ensuring that financially the reporting it has to be accurate, it has to be measured, it needs to be audited to ensure that all those people investing in it are protected. Because basically, when you're looking at governance, so in other words, like following reporting procedures, the more risk the organisation is in terms of the greater the number of stakeholders, the bigger their stake in the organisation, the higher the level of scrutiny needs to be to ensure that they're behaving in an appropriate fashion. So a public limited company has a lot of scrutiny on it. As soon as you get listed on the stock exchange, you have to ensure that you are meeting a number of criteria in order to provide relevant and timely information. So another consideration when we're looking at the operating context for the organisation, how that impacts their finances, is to consider the organisation's financial goals from the point of view from the top level activities through to their operational ones. So we could consider adapting this sort of framework, if you like, for looking at the organisation in terms of how it works for translating their financial objectives downwards. So at a very top level, and when we look at the financial reports for an organisation, their annual reports, they do give a huge amount of information. They're very similar to a marketing document, really, because they are about marketing the organisation as one in which we would be considering investing in. So we need to know where the organisation's going. So very much long term, what is the organisation about? What's its mission and what's its values? And actually, from an investment point of view, people are bothered. They are really concerned about having organisations with which their values are aligned as investors. So this is something that's worth considering about when we're looking at stakeholder engagement and involvement. So this is very broad. Where are we going? And then medium term, what's the strategy to get there? But financially, what are we aiming to achieve in terms of building our financial position? Is it about reinvesting in the business? Is it about expanding it further? What are the goals to achieve our long-term mission? Then we've got our objectives, which can be shorter term. They might be our 12-month objectives, but these are then translated into our key performance indicators. So these may be monitored monthly, daily, weekly to make sure that we're on track. And these are what are measured on an operational point of view. So you could consider here the organisation that you're looking at and how actually all these measures align to create a vision that will allow them to do something that's transformational, especially given the tech nature of the organisation that you're going to be looking at. So we could look at this from the point of view of applying it to different types of organisation. However, from the purposes of your specific organisation, we know it's going to be a tech type organisation. So actually, let's discount the charity and the housing trust because their financial drivers are going to be very different. So we could apply it a little bit more to the retail company, but even then, the pace of it isn't going to be as fast as the pace of your organisation. So actually, I think the retail one is going to be most closely aligned as a form of application. So vision, mission, culture and values, it's all about delivering to customers. So it's about what customers want, but actually from a tech point of view, it might be anticipating customer needs, being one step ahead and stimulating demand. But actually if they're on the FTSE, we've also got to be paying back our shareholders. So we need to be giving them dividends because we want to be an attractive organisation to invest in. Aims and goals. So this is connecting the financial objectives with the stakeholders. So our aims and goals are looking at in terms of, do people want to be associated with the brand? So this could be as an employer, so employees, do they want to work there? Do we provide financial security? So in a high-tech industry, is it exciting, but also do we feel it's got longevity? What's the impact on the community? And this could be a wider community if they're doing something that's truly pioneering. It could have a huge societal benefit, even though it's a high-tech organisation. So it might be profit-making, but still with other drivers. Customers' point of view, has it got a reputation for being a step ahead? Pricing, do they price fairly? So these are the sorts of considerations here financially. Objectives, what are they driven by? Are they pioneering in terms of creating new markets? Do they want a larger share of the market? Are they driven by ethical factors? Are they concerned about the customer perception? This should be something that you can find in their annual reports, or is it profitability? Is it giving that back to the shareholders, reinvesting that back in the business? Whatever they're doing with it, is it profit that drives them? And then KPIs, these are the measures that they use to see if they're on track. And these are the more short-term things that we may see in interim reviews, so like quarterly reports to see if they're on track. So this could be per store, the profit or sales. It could be per product item. It could be looking at profitability. It could be looking at market coverage. It could be about retaining their staff. So this is something that will be quite personal, should be to their organisation, and potentially contribute to their unique positioning. So now on this, we're looking at what sources of funding would be available to the organisation. So internally, this is where we're moving money around. So actually, we could have a significant amount of profit, and rather than distributing it as dividends, we may retain it in the organisation to reinvest and to help us grow. It could be if the organisation is a spin-off from a larger company or a group of companies, they may have some investment from their parent company. Working capital. Okay, so this could be, and this is where a lot of organisations, smaller ones, well, I imagine all organisations have the risk of really falling down. So this could be, I mentioned I've got a training organisation where if I didn't have enough, if I wanted to do something to grow my business, rather than paying my VAT bill, which I don't have to pay for another whatever period of time, I reinvest that money short term into something else. So actually what you're doing is almost borrowing from yourself. So you're borrowing from one pot to put into another pot with the hope of getting it back in time. So this is where organisations have sometimes put themselves at risk by sort of moving money around that's really been allocated for something else because they don't get it back in time. And then externally, so if we can't find it within the business, we need to look externally. So we could look at a bank overdraft. So if we've got a good record with the bank, you're looking at organisations in the FTSE 100 for the tech companies. They're going to have a good, solid track record. They wouldn't have one. They wouldn't be allowed to what's called float, so be on the stock exchange unless they had that. So the chances are the bank would lend them some money, or financial institutions will. So it could be from other financial institutions, or it could be from banks. If they are a smaller startup organisation, they're very unlikely to even be offered overdraft facilities. The banks are really nervous about lending organisations untrusted sort of ones, so you tend to have to borrow on a personal basis. Or they could issue equity shares. So these are shares or more in an initial purchase offering, which is basically floating. So what we know they've already done. So this is where they're issuing shares in exchange for people investing money in the organisation. No, there are far more sources of funding than that. There are other ways of raising capital. There could be angels. So these aren't quite literally angels, these are angel investors. So these are private individuals who are incredibly risk adverse, surprisingly. But these are people who are putting their own money on the line to get involved with organisations they think are exciting. There could be venture capital firms. So these are private organisations, profit driven, who will want to have their returns in a fairly short period of time, but they want to get on board and see huge growth potential in the organisation. Also, the government recently, given the sort of COVID situation, has been willing to lend more money to organisations. So I, again, back to my consultancy business, I've got a what's called a bounce back loan, and that is an interest-free loan for the first year of up to a quarter of your turnover. So actually, say I said my turnover was going to be £50,000 for the year ahead because it's a small organisation. I could then borrow £12,500 interest free for the first year, and then very, very low interest, I think, for 10 years. So there have been additional funding streams available because of the COVID situation, depending on the size and nature of the organisation. But you've got to bear in mind with all this, what's the credibility of the organisation? And given we're talking about organisations that have floated, that have got a good track record, that are seen as trustworthy and credible, the options to secure funding are going to be much bigger to them than other organisations. So it's a bit of a whistle-stop tour in terms of like how they can borrow money, how they might be set up, the sort of reporting they'll need to consider, and we can look in the financial report for more information about this. So now let's have a look at the stakeholder interest. So who is going to be interested in the organisation and what sort of information would they want to know? So again, this is a whistle-stop tour, and we'll be talking about this in future sessions in more depth. So what we need to consider here is the transformation process for your organisation. So what's going into it? So what makes it, so think about your particular one. What actually happens in terms of changing it into something else? So if it's a high-tech business that's producing some sort of hardware, there may be some very specific elements that are bought in. They may be in short, there might be a sort of real demand for them because they're limited supply. The transformation process could be something that's a very skilled one. It could be the one that's outsourced to a different low-cost producing country, or it could be kept in-house, but it's a very specialist process. And then the output would then be something that is potentially packaged, sold. It might be digitized and delivered in that way. But actually, the reason why this is useful for understanding your stakeholders, at each element, different stakeholders are involved. So you've got your suppliers on the input side of it. We need to have a good reputation potentially for securing if we've only got limited suppliers in the marketplace. The transformation process, depending on the level of skill, will depend a different relationship with those stakeholders. So if we need to get very skilled people involved in terms of the manufacture of that process, and then the output is about how we then get it to market. So again, financially, what's our reputation like there? So are we seen as pricing fairly? Are we attractive to do business with? Do we allow if we sell to retailers, do they make enough margin to make it attractive to sell on? So it's quite a good way of looking at the process in terms of dissecting or identifying who might be involved. So here we've got some ideas in terms of, so there's a CMI, go back, CMI checklist, which I will put on Moodle alongside this section. I'll have a look at the checklists that I mention in these and ensure that they're available to you on week one, the resources. So we've got the people that might be involved could consider, well, competitors are going to be interested in your financial performance. Competitors, we cannot hide our past performance from them because we have to share that with our stakeholders or shareholders and our publics. However, what we don't want to do is give them the future information about what our strategies are. So we need to be a little bit vague about exactly how we're going to create our unique positioning, but we also need to be clear enough to attract our shareholders and ensure that they're retained. We can think about all these different groups here and actually look at what their particular stake is and actually what financially they'd be interested in. So employees, I'm just going to focus on, so employees would be interested probably, this is making assumptions, but on financial security of the business, on longevity. Have they got the cash flow to be able to pay like their salaries? Have they got money to invest in the future? Is it looking okay? Is it looking quite solid here? Am I going to be able to ask for a pay rise? So this sort of thing is what we're looking at. Shareholders, longevity, but also short term, am I going to get some dividends back? What sort of, depending on the nature of my relationship, am I putting the money in it for my pension, in which case it's a very different time orientation to one where I want short-term gains. Okay, so the government, as another one, will be interested in longevity, in job security, in terms of innovation in the country as well. So, do they do good things in terms of the reputation for the organisation, or not the organisation, but the reputation of the organisation for the country, which is why the government has stepped in with things like car manufacturers sometimes to support them in difficult times to ensure that the manufacturing base remains in the UK. I think they did a deal once with Cadbury to try and retain certain things in the UK, but it didn't sort of work out, and it did still got transported outside of the UK. So the government is very interested in protecting national, sort of the national interest in terms of industry. So we'll see here we've got again a CMI checklist that I will ensure that you've got those resources available to you. So I've got here another big list of different stakeholders that you may then want to spin out even further. So we could add another layer to this. So actually the owners of the organisation are going to be interested in their returns in terms of, are they going to get their dividends? As a director, you're taking huge risks. You might put paid in directors' loans to finance the business, which is a way early stage businesses tend to get financed by their owners and by their owners' families. So have a look through this and consider, is there anyone else that may be interested in terms of financial information? Community representatives, well, they still have an interest in big organisations because they're employers, but also they can then have a bit of a footfall in a negative way in creating parking and creating a sort of legacy of pollution potentially. But organisations tend to then try and mitigate that by, for example, supermarkets will build in different infrastructure in the city centre to try and sort of compensate for any negative feedback really that they are potentially bringing through opening a supermarket there. We've spoken about employees already. Lender want to see returns, security. They're interested in having something where they get a good supply of money back, actually, so a fair interest rate for what they're giving out. The managers are very much employees. I'm just picking on odd ones here. They will want to be, again, assured a future, but actually potentially see progression within the organisation. So see some cash reserves there. That's what they're interested in. So again, another sort of checklist here that we can go through in terms of analysing who the stakeholders are, but critically evaluate, financially, what do they want to see? So do they want to see, is it profits? Is it turnover? Is it some cash reserves in the business? And where will they find it? And this is where we need to look at these financial reports when Tom joins us to see, where can we see the sort of information these people are interested in. Bit more on stakeholders here. So we've got the power and interest grid. So we will look at our different stakeholders here. So from the previous slide, so we could look at our employees, for example. So our employees, maybe, depending on their level, it could be that they're fairly low power. However, they've got a fairly high interest because of their stake in the business. So actually keeping them informed. So we might send them regular updates in terms of the financial performance. I've just had one through from Coventry University as a member of staff, sort of saying about financially how they're doing. And they always did it previously, any communications were via email, but interestingly, they've started to do them via post, which I wonder is something to do potentially with furloughing staff, so they may not be able to check their emails, but they're trying to engage in a number of different ways. So just have a think here, some of those key members of the key stakeholders, what are we going to do in terms of providing them with information? Is it quite passive? Is it literally like financial we're doing annual reviews, or do we need to do a more sort of active solicitation in terms of if they're financial institutions, do we need to invite them to an event where they're asking questions and they are we're seeking to engage and influence them by talking to them? Is it if it's the government and they're concerned about our financial performance, again that could be high, so we actually could be having steering groups and committees that we're part of connected with the government. So this is very much, we need to repurpose this from the point of view from a financial perspective. This is not just about sort of stakeholder communications, it's about financial stakeholder communications. And again, we've got the checklist there that we can refer to. And then the triple bottom line. So just considering the nature of the different objectives that people, organisations and stakeholders have got. So this is from Slack. it's not just about profit. So profit is one key element of this, and profit is about sustainability actually of the organisation. It's about security as well and longevity. But also, as I mentioned before, and it would be interesting if you could find research on this, but I'm quite interested. So, in my marketing specialism, I've done a lot of work with financial services, and there's a lot of research on ethical investments and this idea that people don't just want to invest in organisations which are returning good profits and security. They also want to invest in organisations that they consider are good, like good eggs, really. So they're sort of they've got values aligned with the people that are investing in them. So there's a huge increase in terms of ethical investments. And when I did this research, I mean, that was like a couple of years ago. I think it will have increased even further over the past year or so, because I think value-led behaviour is becoming increasingly important. And then in terms of customers as well, the customer demand on, so there's a couple of factors that are leading changes in terms of the planet, and I think they're quite demand driven actually. I think there's the governments are putting into place a number of different measures that will penalise organisations that aren't compliant. So things to do with the car or the automotive, where Jaguar Land Rover is moving to eco, from ego to eco, if you like. That's not because that's what the customers are saying, it's because that's what the government is nudging them towards, because they'll be fined otherwise, and therefore their business will be unsustainable. So it's push driven, but also it is pull driven in some ways because consumer tastes are changing, but it's just not. When I give the Jaguar example, that wasn't typically why somebody would buy a Jaguar, because it wasn't anything to do with any sustainability measures, because that's not what they were known for. But the younger consumers, were just more educated consumers. People's awareness in terms of sustainability is increasing, and therefore the performance on those sort of measures also matters. So when we're considering financial performance, we also consider the trade-off in terms of what's the impact that's delivering on the environment. It's all quite interesting, really, in terms of like how they manage to achieve all. And then we've got here actually examples of each of these in terms of like the idea of actually being fair in our supply chain as well. In Yeah, good in terms of the production, and yeah, just the ethics that we've got around our production, that transformation process, if you like, and through back to our supply process, the input before the transformation. So even outside of our organisation, there's an expectation that we do good, that we don't buy from sweatshops, that we don't. Quite a few years ago now, it was Primark was one of the organisations, a fast fashion one, that because of its supply from India, there was an Indian factory that burnt down and a significant number of deaths. And that was very much sort of investigated, but also through association, the fast fashion industry was really questioned on its integrity and its ethics in terms of passing back that need for inexpensive supply to the detriment of actually human life, you know. So yeah, that's quite interesting, the people side of it, the supply of it, the planet in terms of, you know, how we're now producing it. That will affect costs. In some ways it can reduce costs because it gives an excuse to reduce packaging, to consider the most efficient ways of doing things, to consider carbon footprint, but it also could actually increase cost in terms of the ways in which things are produced, the cost for eliminating materials in a safe and ethical way. And then actually profit, you know, making sure that we are making a fair profit to be able to be sustainable, that we can reinvest, that we have that money to pay that surplus, and that we can actually maybe even support our supply chain if needs be, so that they're able to work with us in the future as collaborators. So again, this is very timely, really, in terms of sort of being quite interesting. There is also, I've put the slides on Moodle, so if you do wish to look further, you could have a look at in terms of this idea of ethical investments and sustainability, in terms of it not just being about being green, but also the financial argument behind it. So I mentioned we're going to look at the different types of all the sort of learning outcomes for the first assignment in a whistle-stop tour in this session. So the next thing that I wanted to show you is really the different types of financial statements that you will see. Potentially not all of them in the financial statements for the organisation, the annual report, but I imagine you may do. So let me just give you an overview, and you can obviously read this at your leisure. So we have three different main financial statements, and as a small organisation, if you're submitting these to Companies House, you wouldn't submit the cash flow, you don't need to. However, your organisations may well actually publish an idea of their cash flow statement just to give confidence that they've got the liquidity, so in other words, the cash available to sustain the business as it grows. But for smaller organisations, all they need to submit to the government, to HMRC or Companies House, it's called, that part of the government, is the balance sheet and the profit and loss. So the balance sheet looks at a certain period of time. So this will tend to be annually for the government's point of view, but actually it's also, it can be quarterly that they look at it. And it looks at all the assets, so that's everything you own, everything that's a plus, if you like, all the good stuff, the stock that you've got, the intellectual property you've got, um, and then you look at all the liabilities, so everything you owe. And the idea is that they balance together and they show the position of the company at one point in time. Okay. So it's seen as being, it's always going to be out of date because the next day it's going to change anyway. And it's literally a snapshot in time of everything that you owe, everything that you sort of, every invoice that you haven't paid out, all the versus all the assets that you've got. And the idea is that they must always match. And actually, the matching might be if you have a lot more, if you don't have much debt, if you don't have much borrowing, but you have, and you're in a strong cash position, then that surplus you could do something with, but it still matches. So it shows a surplus there, whether that's reinvested in the organisation, whether it's paid as a bonus to the employees, whether it's paid out to the shareholders, that's fine. But it's matched, so you can see what you can do with that money and on what sort of how much money, or it might be a loss that's also shown, but either way it's a very clear picture of what you've got versus what you owe. Cash flow shows what's coming in and out at any point in time, and actually a really, really dangerous position for an organisation is when they take on a huge contract, which sounds like it should be amazing. And the reason it's dangerous is because things like that cost a lot of money to run. So actually, before I can even invoice for it, if I've got a significant piece of work coming in, I'm going to have to pay people to do it for me. So I'm paying money out, and then when I've delivered it, I can then invoice for it. And if I'm lucky, I'll get paid in 30 days, but it may be 90 if it's a really big piece of work, because organisations with significant budgets tend to be quite difficult sometimes in terms of not great payers. So that could put me out of business because I've already paid out 50 grand for this new piece of work to have it delivered, and I'm going to make 150 grand if I can stay in business long enough for them to pay me back. So cash flow is really quite important because it's not profit, it's just making sure I've got enough money coming in and out that I'm okay. And actually, if I'm not okay, I know in advance, so I can think, well, I'd like to take that contract on, but in order to take that contract on, I need to borrow so much money from the government, or get a bounce back loan, or I need to borrow from my bank in order to secure and deliver on that contract. And then the profit and loss is really showing, the sales that I've got, so the turnover less the costs, and then you've got sort of gross profit, net profit. So you're considering all the things that you have to pay for, and you ultimately get to a figure which is the profit after you've paid. It's basically the government wants to know the level of profit that you're earning because they will then issue your corporation tax based on that. So the profit and loss for the government is really important because it's about how much they can ask you for based on your the profitability in the organisation. And it's also going to be of a huge amount of interest to your shareholders as well, so they can understand how much can be reapportioned, or actually if you're at a loss as well. But that's historic. So cash flow looks forward. So let's go from the start. A balance sheet is a current photograph of what we've got at this point in time. Our cash flows looking forward is what's coming in, what's going out, how's that going to look? And our profit and loss is looking backwards at the year, potentially the year that's just gone by. So just in terms of like the another way of looking at this, as I mentioned, the balance sheet will look at how we're getting money. So actually, how that money's been achieved. Is it going to be through directors' loans? Is it through the shares we're getting in? Is it through, if it's charity, through donations, are we borrowing it from the government? And then it's actually what assets we've got. So short term, what stock have we got? Have we got an asset value through the retail premises we might have? And then long term, actually, what intellectual property have we got? Have we got some patents there? So as I mentioned, it's sort of borrowings versus the good stuff that we've got to counteract that, so that the assets we've got. And then this feeds in to our transformation process, because all that allows us to do something with it, because that's the current situation, to transform it, to then go ahead to look at how much it's costing us to deliver on these things, and then other income that we might get in. So this is all stated in our profit and loss. So other income could be rental income if we've got assets, long-term assets. It could be Virgin, actually don't know. They basically license a number of their brands and they make money from doing that. So it could be a number of different sources of income. It might not just be sales. So we've got here this idea that actually we've got profit or loss. So a profit or an additional amount of money, a surplus, as it's known in a charity, we can then reinvest that in our organisation. But then a loss, we need to look at how to fund that to make sure that we're sustainable. So we've looked at the main financial statements there to understand the sort of the key financial information and the key accounting techniques that are used and what they tell us. So very much an overview there, but I'm trying to give you sort of a bit of a flavour of what financial information looks like, and we'll look at this further with Tom. So this is really an introduction, but also we also looked at who the key stakeholders are that might be interested in it. So for the next session, not as in like today, but next week, I'm really keen that you identify which organisation you'd like to look at. Bear in mind you're going to need two. So you're going to need one for this second assignment, so this one where you're looking at the future, creating a product or service or a division. So something that's quite innovative in that sense, but you're also going to be looking at doing a case study on one. So just consider here two organisations, but really the first one that you're focusing on for the case study. So just in terms of accountability, if you could email me before next week the organisation you're doing for assignment one, that would be fabulous. It doesn't mean you can never change it, but it just means you're starting to think of one. So I'd really like that. But don't email me, but start thinking about the financial context in which they're operating. So actually, how are they doing their reporting? And just the sort of stakeholders really that they're looking at, and what the stakeholders who are interested in them and what the stakeholders are looking at as well. So starting to apply some of the contents that I've just gone through with you in this session. And then I think the final slide is the resources, but bear in mind, as I have mentioned on the introductory recorded session, you've got that fabulous reading list from Tallis, so don't necessarily look to any of this, look at more recent reading, because this is all when the original material was developed a number of years ago, so you've got better quality links now, more recent reading, so look at those to support your knowledge, and I'll put the CMI fact sheets on the Moodle page as well. Okay, I'll see you shortly, thank you.